Hi, welcome to another investor web video. Today we are going to be looking at ways you can use to catch up on your mortgage payments. If you are falling behind on your mortgage payments, there is no shame in missing a mortgage payment because almost everyone has experienced financial difficulties in their life. Some of the reasons for this may include job loss, divorce, pandemics, or serious illness or injury, and it's often beyond the individual's control. It is critical that you seek assistance immediately. The first step is to contact your loan servicer and explain your situation. Many people are hesitant to take this step because they are scared and intimidated. To avoid foreclosure, it is critical to take decisive steps. Here are 6 methods for catching up on your mortgage payments if you are behind. Number 1. Forbearance. Forbearance is a plan devised by a lender and a borrower who is having difficulty making mortgage payments in order for the borrower to fulfill the mortgage obligation and avoid foreclosure. In general, the agreement reduces or completely suspends mortgage payments for a specified period of time during which the lender agrees not to foreclose on the property. This is the best choice for people who are experiencing a temporary financial hardship or income disruption. It's simply a method of deferring payments without being considered negligent. The disadvantage is that you will pay more interest by effectively extending your mortgage term. Number 2. Lump sum. This is a method for homeowners to pay back overdue payments after their financial situations improve. A repayment plan requires you to make regular payment amount plus an additional amount for as long as it takes to make up for late payments. Servicers must, of course, be convinced that your financial situation has improved to the point where you can handle a larger monthly obligation. The difficulty is coming up with a large sum of money. It is probably not a good idea if you're just getting back on your feet financially because this plan can be capital intensive in a short period of time. Number 3. Loan modification. A loan modification is similar to a refinance. You obtain a new loan that has a longer repayment period or a lower interest rate. Any loan can be adjusted, and in some cases, it is the only way to ensure that you can continue making payments on the loan. Many lenders will consider this alternative. Remember that many people are unable to make their payments due to the loan's strict terms, but a lender may be willing to consider a modification in some cases. You must meet some certain criteria, such as demonstrating financial or personal hardship. Number 4. Same mortgage, but lower payments. Another option is to try to get your private mortgage insurance, PMI, terminated so you can get out from under this obligation. This may be possible if you have enough equity in your home. Homeowners frequently postpone this payment for longer than necessary. If you haven't already done so, your financial difficulties may be the driving force to do so. However, if the servicer is threatening to foreclose, PMI can sometimes be used to save your home. In this case, you can submit a partial private mortgage insurance claim. Rather than paying your servicer the full amount of your claim to avoid foreclosure, the insurance company only pays the servicer enough to cover your missed payments. For confirmation, carefully read your PMI policy documents or consult an attorney. Number 5. Principal lessons. Principal reductions resulted from the 2008 to 2009 financial crisis, which was largely caused by the subprime mortgage housing bubble. The term subprime refers to loans made to borrowers with low credit scores that did not qualify for the loans. As a result, many people found themselves well over their heads in housing they couldn't afford. The growing real estate bubble burst as people began to default on their mortgages. Housing prices fell, leaving many people in negative equity. In response, the United States government established the Home Affordable Modification Program, HAMP, as well as other principal reduction programs. In a nutshell, based on the actual value of your home, the servicer may be able to reduce the principal on your loan. This can lower your monthly payments by lowering the amount you owe on the loan. Conclusion. Ignoring missed mortgage payments will worsen the situation and may lead to foreclosure. For homeowners, foreclosure can be a painful and stressful legal process. Eventually, it means that the lender has the right to seize your home or evict the homeowner and recoup as much of the loan as possible, with penalties and fees attached. Foreclosure can have a significant impact on your financial health, including your credit score, ability to obtain a new loan or credit card in the future. When you fall behind on your mortgage payments, the sooner you act, the better. And with that, we have come to the end of today's video on ways to speed up your mortgage payments. Thanks for watching. If you liked this video, make sure to subscribe to Investor Web for more.